Tax Planning Success Stories. Chapter 1, REITs and RELPs.
Real estate investment trusts, REITs.
Real estate investment trusts, REITs, are companies that own, operate, or finance income-producing real estate across a range of property sectors. Established by Congress in 1960, REITs provide all investors the chance to own valuable real estate, present the opportunity to access dividend-based income and total returns, and help communities grow, thrive, and revitalize. REITs allow anyone to invest in portfolios of real estate assets, the same way they invest in other industries, through the purchase of individual company stock or a mutual fund or exchange-traded fund, ETF. REITs offer several tax advantages, making them a popular choice among investors. One of the most significant benefits is that REITs are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This requirement allows REITs to avoid paying corporate income tax, which can result in higher returns for investors compared to typical corporate stocks. Additionally, dividends paid by REITs are often taxed at a lower rate than ordinary income. Under the current tax law, a portion of REIT dividends may qualify for the 20% pass-through deduction, which effectively reduces the maximum tax rate on these dividends. This tax treatment can enhance the after-tax returns for investors. REITs also provide a level of diversification that can be difficult to achieve through direct real estate investments. By investing in a REIT, individuals gain exposure to a diversified portfolio of properties and real estate sectors, which can help mitigate risks associated with owning a single property. This diversification can include various property types such as commercial, residential, industrial, and specialized real estate like data centers or healthcare facilities. Another advantage of REITs is liquidity. Unlike direct real estate investments, which can take months or even years to buy or sell, REIT shares can be traded on major stock exchanges, providing investors with the flexibility to quickly adjust their portfolios in response to market conditions. Successful examples of REIT investments often highlight the combination of income generation and capital appreciation. For instance, during periods of economic growth, REITs that invest in commercial real estate may see both rising property values and increasing rental income, leading to higher dividends and stock price appreciation. Conversely, during economic downturns, REITs investing in essential sectors like healthcare or residential properties may offer stable returns due to consistent demand. In summary, real estate investment trusts, REITs, offer a compelling investment opportunity by providing access to a diversified portfolio of income-producing real estate, favorable tax treatment, liquidity, and potential for capital appreciation. These characteristics make REITs an attractive option for investors seeking to enhance their portfolio with real estate exposure without the complexities and risks of direct property ownership.
Real estate limited partnerships, RLPs.
Real estate limited partnerships, RLPs, are investment vehicles that pool capital from multiple investors to acquire, manage, and operate real estate properties. RLPs typically focus on specific types of properties, such as residential, commercial, or industrial real estate, providing investors with targeted exposure to particular sectors of the real estate market. One of the main advantages of RELPs is their ability to offer investors access to large-scale real estate projects that would be difficult to finance individually. By pooling resources, investors can participate in the ownership and potential profits of significant properties that generate income through rental yields and appreciation in property values. RELPs are structured with a general partner, GP, and limited partners, LPs. The general partner is responsible for managing the partnership, making investment decisions, and overseeing the day-to-day operations of the properties. Limited partners provide the bulk of the capital but have limited liability, meaning their risk is confined to their investment amount and they are not involved in the management of the partnership. Tax benefits are a notable feature of RELPs. Investors in RELPs can benefit from pass-through taxation where the income and losses of the partnership are passed directly to the partners, avoiding the double taxation faced by traditional corporations. This means that profits are only taxed at the individual level, potentially lowering the overall tax burden for investors. Additionally, RELPs can take advantage of depreciation deductions to offset income, which can further enhance the tax efficiency of the investment. Despite the benefits, investing in RELPs comes with certain risks. The illiquid nature of real estate means that it may be challenging to sell partnership interests quickly, and investors should be prepared for a long-term commitment. Furthermore, the success of the investment largely depends on the expertise and decisions of the general partner, making it crucial to choose RELPs managed by experienced and reputable professionals. Successful RELPs often showcase the potential for high returns through strategic property acquisitions and effective management. For example, a RELP focusing on commercial properties in a growing urban area might see substantial rental income increases and property value appreciation, leading to significant profits for its investors. In conclusion, real estate limited partnerships, RELPs, provide a means for investors to participate in large-scale real estate ventures with potential tax advantages and high returns. While they offer many benefits, careful consideration and due diligence are essential to mitigate the inherent risks and maximize the potential rewards.
Chapter 2. Like-kind exchanges and property tax appeals.
Like-kind exchanges, 1031 exchanges.
Like-kind exchanges, also known as 1031 exchanges, refer to a tax deferral strategy that allows real estate investors to defer paying capital gains taxes on an investment property when it is sold, as long as another similar, like-kind property is purchased with the profit gained. The term like-kind refers to the nature or character of the property being exchanged, and not its grade or quality. One of the primary benefits of a 1031 exchange is the ability to reinvest the entire proceeds from the sale of a property into a new investment without immediate tax liability. This deferral can significantly increase the amount of capital available for investment, allowing for the acquisition of higher value properties or diversification into different types of real estate. To qualify for a 1031 exchange, the properties involved must meet specific requirements. Both the relinquished property, the one being sold, and the replacement property, the one being purchased, must be held for productive use in a trade, business, or for investment purposes. Additionally, the exchange must be completed within strict time frames. The replacement property must be identified within 45 days of selling the relinquished property, and the acquisition of the replacement property must be completed within 180 days. Another critical aspect of 1031 exchanges is the role of a qualified intermediary, QI. The QI facilitates the exchange by holding the proceeds from the sale of the relinquished property and using them to purchase the replacement property. The investor must not receive the proceeds directly, as doing so would disqualify the transaction from being treated as a 1031 exchange. Despite the advantages, there are potential risks and complexities associated with 1031 exchanges. The strict timeframes and specific rules require careful planning and execution. Additionally, while capital gains taxes are deferred, they are not eliminated. If the replacement property is eventually sold without utilizing another 1031 exchange, the deferred taxes will become due. Successful 1031 exchange cases often highlight the potential for significant tax savings and increased investment potential. For instance, an investor might sell a small rental property and use a 1031 exchange to purchase a larger commercial property, thereby deferring taxes and increasing potential income streams. In summary, like-kind exchanges, 1031 exchanges, offer real estate investors a powerful tool for deferring capital gains taxes, increasing investment capital, and facilitating portfolio growth. However, the process requires meticulous planning, adherence to regulations, and often the assistance of experienced professionals to navigate the complexities involved.
Successful property tax appeals.
Successful property tax appeals can lead to significant savings for property owners by reducing the assessed value of their property and consequently their tax liability. The appeal process involves several key steps that, when executed correctly, can improve the chances of a favorable outcome. The first step is understanding the assessment process. Property owners should familiarize themselves with how their property's value was determined by the local tax assessor. This includes reviewing the assessment notice, checking for errors, and comparing the assessed value with recent sales of similar properties in the area. Gathering evidence is crucial. Property owners need to compile documentation that supports their claim that the assessed value is too high. This can include recent appraisals, sales data for comparable properties, photographs showing the property's condition, and any repair estimates that highlight deficiencies not considered in the assessment. Filing the appeal within the designated time frame is essential. Each jurisdiction has specific deadlines for submitting property tax appeals. Missing these deadlines typically means losing the opportunity to contest the assessment for that tax year. Presenting a compelling case is vital. During the appeal hearing, property owners must clearly articulate why they believe the assessment is incorrect and present their evidence logically and convincingly. Being well prepared and organized can make a significant difference in the appeal's outcome. Professional assistance can also enhance the likelihood of a successful appeal. Hiring a property tax consultant or attorney who specializes in property tax appeals can provide valuable expertise and increase the chances of a favorable decision. In summary, successful property tax appeals require a thorough understanding of the assessment process, diligent gathering of supporting evidence, timely filing, and effective presentation. With careful preparation and, if necessary, professional assistance, property owners can achieve significant tax savings through a successful appeal. Thank you for watching. If you enjoyed this video, please give it a thumbs up and let us know in the comments below. Don't forget to subscribe to our channel for more great content like this. Hit the bell icon to get notifications whenever we upload new videos so you never miss out. We appreciate your support and look forward to bringing you more exciting videos.
The voices in this recording were created with the assistance of OpenAI.